Hi, good day to everyone. Today we'll move on to goodwill in partnership. How the valuation of the goodwill is being done in the partnership. So we would have done in admission that goodwill is one of the important item which the new incoming partner is bringing. But there are different methods of goodwill valuation which we are going to see in today's class. Okay, so basically there are four methods of goodwill. That is what we are going to see in today's class. First, moving on to what is goodwill abdina. It's a good name and fame and the reputation which the business have earned during the period. That is what the goodwill means. Okay, so for example, or 5 years A and B are in partnership, they would have earned some good name. So suddenly they are going to share the profit with C. So they might ask C, the new partner, to bring in some amount of goodwill for his share. So for that purpose, definitely every partnership sumla admission they will value the goodwill. This valuation of goodwill can be done in any of the four methods, or they would have given you the value of the goodwill. Okay, in today's class we are moving on to the methods of goodwill, valuation of goodwill. So first method we call it to be average profit method. So average profit method we have simple average method and weighted average method. So this is such a simple chapter for 12th standard, so where they can easily, without any complication, and you can score the mark. Okay, if you follow the steps. Simple average method there are 4 steps. Okay, so the formula is goodwill is equal to average profit into number of years of purchase. So what is the thing we have to find out now? First, find out what is the normal profit for the 3 years period or 4 years period they would have given you. Second step, find out the average profit. Average profit is nothing but total all the 3 years profit divide by 3 years. 4 years na 4 years add pannunga, divide by 4. If it is a loss in any year na 3 years add pannittu 4th year loss na subtract the loss amount, divide by 4. Okay, that is the logic. And suppose they give you certain adjustment relating to after in future certain expense, certain income is not been going to be repeated now, you have to find out the average profit. From the average profit you can make the adjustment and find out what is the adjusted profit. Adjusted profit you can do it. If this adjustment is not given abdina, you can skip this step and straight away go to value of the goodwill. Okay, so if they give you past expense which is not required in future add it back. Additional income expected in future add. Okay, past revenue not likely to be earned in future. Okay, it's not going to be earned, so subtract it. Additional expenditure expected to be paid, so henceforth you are going to pay some expenditure, now you have to subtract. So make all these adjustment and you will find out adjusted profit. Okay, average profit if the information is given you will do it. Then value of the goodwill is equal to average profit. You would have find out that profit into number of years of purchase. If they give you the adjustment, after this do the adjustment, then you will get the adjusted profit into number of years of purchase, you will get the value of goodwill. Okay, this is simple average method. Now moving on to weighted average method. So weighted average method what is the difference now? You will assign weights to the normal profit. So they would have given you 4 years profit, I think 18, 19, 20, 21. So 21 you will assign, latest year you will assign 4 as a weight. அதுக்கு முன்னாடி 20க்கு 3, 19க்கு 2, 18க்கு 1, like that you will assign the weights for each year profit. Okay, then you will find out what is the weighted profit. That is, you will have the normal profit, you will have a table madri. Okay, so the table normal profit you will have, weighted weights you will have, you will multiply these two things and you have weighted profits. Okay, so weighted profit is normal profit into weights. Then total this product, total the weights. Then you will have total weight of the profit by total weights divided, you will get average weighted average profit. This weighted average profit into number of years of purchase, same thing you will do it. Okay, so this is how you will do it. Next, super profit method. Super profit method these are the steps which you will follow it. Okay, first step what you will do you will find out what is the adjusted average profit. Last time I told you, no, the same step you will find out. Each year you will adjust. Each year there will be, okay, normal profit each year that is the difference. So each year you will make the adjustment and find out. Then find the normal profit. Okay, normal profit there is a formula: average capital employed into normal rate of return by 100. For this you need to know what is the capital employed. Okay, if the capital employed is given, you can straight away find out this, go to step 4. But if the capital employed is not given, you have to go and find out what is capital employed. That capital employed you can go by calculating either asset method or liability method. If not given any of the one method, you can go and find it out. Okay, so normal profit you will find out average capital employed into normal rate of return by 100. That answer you will have it. Then adjusted average profit you will find it out. Okay, same step you will follow and find out. The difference between the adjusted average profit and the normal profit is what they call it to be the super profit. Logic enna, with the amount of the capital employed in the firm, normal return normal profit would have been this, but you're earning something extra. Adjusted actual profit is your firm's profit. So the difference between the two is known as the super profit. That super profit into number of years of purchase is what you will get it to be the goodwill. Okay, so this is how you will go and find out the goodwill under the super profit method. So super profit method simple. First definitely there will be some adjustment giving for every year. So adjusted actual average profit you have to find out. Then normal profit you have to find out. Normal profit if it is given, you can straight away take it. Otherwise you have to find out what is the capital employed, and from the capital employed multiply the normal rate of return by 100, you will get the normal profit. Difference between the actual adjusted profit and normal profit is what is super profit. Super profit you multiply by number of years, you will get the goodwill. Okay, next is such a easy thing, that is capitalization of average profit method or capitalization of super profit method. This is what the next thing. Anything and you can do it. So what is a simple answer na? Goodwill under capitalization of super average profit method enna, capitalized value you have to find out minus your net asset. Capitalized value how you are going to find out na, adukku formula na average normal profit kandupidichom illingla, first method adhe da average normal profit into 100 by NRR, normal rate of return. If you do the average profit ki in the firm la invest panna, what should have been the capital அப்படினு ஒரு ஆன்சர் வரும். அந்த capital minus the net asset, what the net asset you are using in this firm. Difference between is what they call it to be the goodwill of the firm. Okay, so net asset sometimes they will give you directly the amount, otherwise you have to go and find out. Same way net asset enna, all the asset other than the goodwill fictitious asset minus the outstanding liability. If it is not given, you can use this formula, or if it is given, substitute that answer and find it out. Okay, so capitalization of average profit enna, capitalized value of the firm minus net asset. Capitalized value of the firm is average profit into 100 by NRR. Okay, net asset if it is not given, you use this formula. All the assets other than your goodwill and fictitious asset minus your outstanding liability. Okay, next comes the easiest, another capitalization of super profit method. So enna, they all 6 steps you will follow, and super profit you would have got answer la, and the super profit eduthu super profit into 100 by normal rate of return. If you do, you will get the goodwill straight up. Okay, so super profit for 8 steps we followed la, what is average profit, what is normal profit, ella step of follow panni you will find out. Super profit is equal to adjusted actual profit minus net profit panni you will get the answer, that into 100 by normal rate of return. If you do, straight away goodwill answer you will get it. Okay, so such a easy chapter this is, valuation of goodwill. Definitely you can expect a 3 marks or 4 marks from this. Okay, thank you.